Tom Bowley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everybody. Welcome to this Thursday, January 4th, 2023 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes or so as we prepare for another trading day. So far, 2024, not off to a great start. We were a little bit overbought, well, maybe a lot overbought, ending 2023. And so I think we've seen some profit taking, a little bit of rotation. Some of the areas that led the market in 2023 continuing to underperform so far in 2024. Areas like technology, consumer discretionary, all 21 industry groups yesterday in the consumer discretionary area were down. So we're definitely seeing a little bit of rotation, which isn't a horrible thing. Going to go through some of the numbers with you here in just a second. I do want to mention a couple of things, though, first before we get started. Tonight or this afternoon at 4:30, I will be hosting a January Effect event on behalf of EarningsBeats. And if you're not familiar with the January Effect, it's really quite phenomenal. The accuracy of the signals that it gives is quite remarkable. Essentially, what we're looking at is, how strong is January? And then we go by the old Wall Street adage, as goes January, so goes the rest of the year. It's not a guarantee, but I tell you, it's pretty darn close to a guarantee. And I'm going to go over those numbers and show you a couple of very, very interesting charts during this webinar at 4:30 today. You do need to be an EarningsBeats member, but you can be a trial member. And we do have a 30-day free trial. So make sure you go over to EarningsBeats.com, check us out, come join me this evening. I think you're going to be pretty surprised, probably rather wide-eyed by the time it's over, especially if you haven't heard about the January Effect before, or you haven't listened to somebody who's done a lot of research on it. But I find it really remarkable, and I think you'll enjoy it. So make sure you tune in for that. And then, of course, on Saturday, it's our big event of the year. This is the biggest event we do all year. It's our Market Vision 2024 event. It'll start at 9:30 a.m. Eastern Time on Saturday, January 6th. So in order to join, well, the best way to come to this is to be an annual member of EarningsBeats, because it is free to anyone who is an annual member at EarningsBeats. The event will be free. If you are a trial member, you will save about $350, 50% off. So even just trying us coming to the event tonight, you can save $350 if you sign up for the Saturday event. And again, if you're an annual member at EarningsBeats, you pay nothing. So makes a lot of sense to give us a try for tonight's event. If you've seen, check us out, kick the tires. And if you think this is something that you'd, be interested in, sign up for the annual. You won't lose your 30-day trial, by the way. If you're 2 days into your 30-day trial and you're like, okay, I like the service, I like what you're doing here, let's go ahead and let's go with it, you'll get the rest of your 30-day trial, and then your annual membership will be added on to the end of that. So don't worry about coming in and only getting 2 days for under the free trial. You'll continue to get the rest of your trial. I think that's probably all I got for now. There were a couple economic reports out. Usually I go over that with the 10-year Treasury Yield, but we do have the ADP employment report that came out this morning. It was a little bit hotter than expected, but not too hot. Let me see. Initial jobless claims came out about 15,000 beneath estimate, 202,000 versus 217,000. And let me get that ADP number up if I can. So the prior month, so the number I'm going to give you is for December, but the prior month in November was revised from 103,000 to 101,000. So it was revised slightly lower. In December, the consensus estimate was 115,000, and we actually came in at 164,000. So definitely a beat on the jobs number. Of course, the big numbers tomorrow morning, that's the non-farm payrolls. That's the one that most traders pay attention to. That's the one the Fed pays attention to as well. So I'm much more interested in where that comes in, but at least we have a pretty solid report on the ADP employment report this morning. All right, let's go ahead and take a look at what happened yesterday. I got A lot going to try and get through today. One thing I do want to try to get through is taking a look at all 30 Dow component stocks. The Dow Jones has been performing pretty well. It ended last year pretty strong during that November, December push, and it's also gotten off to a relatively good start here in 2024. So I thought this would be a great time to take a look, and I'm going to look at it from a 5-year weekly standpoint. So at the end of the show, you have that to look forward to. I'm going to try and go through like a lightning round, get through 30 Dow stocks, looking at their long-term charts. All right. Yesterday, Dow Jones Industrial Average was down 285 points, which was about 0.75%. S&P 500 down 38. That was 0.8%. The NASDAQ 100 was down 175 points, which was down a little bit more than 1%. Mid caps and small caps is where most of the selling took place yesterday, at least the bigger selling, with the mid caps down 63 points, which was down 2.25%. IWM, or the Russell 2000, the IWM dropped $5.325. That's a pretty big drop on the IWM, losing about 2 2/3% yesterday. Transports dropped 1.7%. That was 270 points. I thought maybe we would see some support right around 15.5, 15.6. Well, we finished at 15.504. So we are right on some support. I'd like to see a bounce back there. We lost the 20-day moving average on a couple of key indices. The S&P trades almost right on it, but we had the Dow Jones still sitting above it. NASDAQ 100 lost the 20-day moving average yesterday, as did the mid caps, the small caps, and transports. So at least in the short term, we had a couple of breakdowns that we need to keep an eye on. But for now, just a slight break. Obviously, if we put in some sort of reversing candle or we can climb back up above that 20-day moving average, it would be much more bullish. I always like trading above the 20-day rather than below it. Energy, big winner yesterday. Energy gaining 1.6%, jumping back up over $86. PPO above zero, starting to strengthen. And this is the highest close we've seen now since back at the beginning of November. So we're at about a 2-month high on energy. Energy kind of likes, I'm going to show you an interesting seasonality chart just over the last handful of years or so. But recently, energy's done very well in the month of January. So I'll talk about that a little bit later. Utilities also up, gaining about one little bit more than 1/3%. Also in an uptrend above the 20-day. And then finally, healthcare, which has been strengthening, continued yesterday. It was up early, did finish down on the session, down a little bit less than 0.2%, but it did manage to put in higher high, higher low. And we've got that PPO continuing to strengthen along with the AD line, which is moving up with the price action as well. So all in all, those three areas, of course, you don't see any aggressive areas in there. That's a little bit of a problem. But when the market is generally pulling back or rotating during maybe a pullback phase here, that's not unusual. That's actually normal. Where I start to get more concerned is when the market rallies. Let's say we have a rally from here, go back up, set new highs, and each day along the way we see or hear nothing from the aggressive groups in terms of leadership. That would be something that would start to make me a little bit more nervous about where we stand in the market. Right now, on a pullback, I'm okay with that rotation. Looking at the individual industry groups, this is the exploration and production area. This was your top performing industry group yesterday, gaining almost 1.8%. You can see also trying to take out multiple highs, just a little bit above 1,050. We'll see maybe if we can get a little bit of follow through today, but that would be bullish for the exploration and production group if it were to occur. Pharmas, talked about pharma strengthening day before yesterday. Well, they added on yesterday another 1.5% on the pharmas, jumping up and now getting close to that 860, 870 area where it does have some key overhead resistance. Finally, specialty finance. Specialty finance breaking out above recent highs. This is about a 3.5 month high on the group, and I always like that. So we are, like I said, we're seeing some rotation rather than money just totally leaving the market. That's where you start talking about some significant distribution, which is what we saw at the beginning of 2022. This we're starting to see. Well, we're seeing more rotation. There's a lot of groups that have been weak that are starting to strengthen. So underneath the surface, what I'm seeing is more and more groups participating in this advance, which I think is bullish. Let's see what happens on the next rally, though. That's going to be key. All right, moving on to the 10-year Treasury yield. Again, I pointed out those couple of economic reports that came out earlier, and we were up. Let me see where we are now. Yep, we're still up at 3.99% on the 10-year Treasury yield, but also still below that 20-day EMA. The 20-day EMA currently is at 4%, so we're not much below it, but we are just below it at 3.99. You can see that PPO now, we've gotten across. I look at the PPO a little different than everyone else, or most everyone else. While a lot of folks look at the cross from below to above the trigger line, and for those of you who don't understand the PPO and the trigger line, the PPO is simply the difference between two exponential moving averages. The default, the one I always use, is the difference between the 12 period and the 26 period EMA. So in this case, it's a daily chart. So it's the 12-day and the 26-day moving average. When you are trending down below the zero line, it's telling you that your short-term momentum, the 12-day moving average, is below your 26-day moving average. So the short term is accelerating to the downside faster than the long term. So that's definitely more of a bearish type of move to the downside. And so as long as we're going down, and this is the PPO is going down and staying below this red line. So now what's the red line? The red line is the 9-day moving average of the PPO. So it's just a moving average of itself. So it's pretty much just kind of smoothing things out. But because it's a 9-day moving average, it turns slower than the actual PPO reading. So here, when we started to get a push back to the upside, you can see that move to the upside here on the PPO, crossing over this 9-day moving average, which is the trigger line. A lot of technicians look at that very bullishly. I look at it more bullishly than when it's going down, but I still look at it as cautiously. This is not bullish momentum. This is less bearish momentum. Big difference. When you're below the zero line, that's bearish. When you're above the zero line, that's bullish. Very simple. Again, this is telling you whether or not your short-term moving average is above or below your longer-term moving average. So a lot of times what happens is we get these false crosses, and then a lot of times we end up going back down and either setting new lows on the PPO, or maybe that's where we'll get a positive divergence, where the PPO will not go down as far as it did before, and yet the yield in this case would go down and set a new low. So just want to kind of clarify that, because that's one thing that, when I hear technicians say this is bullish or the momentum is bullish, that is not bullish. That is less bearish. Make sure you understand that distinction. All right. One thing I'll say is that, when we were going up, we typically see the financials outperforming. Normally, when the 10-year Treasury yield is going up, it's actually, you're getting more of a spread between your long-term Treasury yields and your shorter-term Fed funds rate, or your shorter-term 1-month Treasury, whatever. And so instead of instead of having a inverted, thank you, couldn't think of the word. Instead of having an inverted yield curve, this is the opposite. Shows a spread, a positive spread between the longer term and the short term. That's the normal way this acts, okay? So normally when this goes up, if you look back at history, you'll see financials normally go up with interest rates going up. In this case, they were flat. They didn't really follow. And now with rates going down, normally that means financials will underperform. Now we've got financials coming up. So we've got kind of a strange kind of a divergence that's been taking place. But I would just suggest this. Think about what's causing rates to go up and down. Is it the economy, or is it the inflation scare? What's been driving interest rates? What do you think has had the most impact? I have my answer. I think it's inflation. That's the big difference between when you start looking at intermarket relationships. They don't always work out. You got to think a little bit outside the box. Too many times we go back and we look and we say, well, the last 4 times rates have gone up, financials have outperformed. Well, probably the last 4 times rates have gone up, it's because the economy is strengthening and the Fed wants to kind of make sure that we don't overheat. And so they start tapping the brakes a little bit by raising rates. And we start to see a little bit more anytime the economy's picking up, in bond investors, especially long-term bond investors, are going to start looking for the possibility that inflation could come into the picture. And if they start thinking at all about inflation, they will sell bonds because they require higher yields. Nobody wants to hold a 3% or even a 4% 10-year Treasury bond if inflation's at 6%. Great. You just lost 6% buying power and you replace it with 4% dividend. You just lost 2%. So that's one of the things that drives yields up. We have to always be aware of what is causing rates to go up and rates to go down, because that is a big difference between what's going on in the economy. So financials, and if you think banks normally will do well when rates are rising, when the long-term rates are rising, and normally not so well when rates are coming back down. Just keep that in mind as we go forward, because we're going to have to deal with interest rates in 2024, but mostly in what I consider to be a more dovish or favorable light. All right, S&P 500, there you go, move up. Here's your pullback. There's the 20-day test. One thing I will point out, gap downs. You know how I feel if you've been following me for a long time, last couple of years anyway. You know how I feel about gap downs. I feel like there's manipulation that takes place. Market makers determine opening prices. And one way to go down is for selling throughout the day. And another way to go down is for market makers to create that sense of selling. I look at this and I don't really see a whole lot of selling the last 3 days on the S&P 500. I mean, on this would have been December 29th, which was last Friday. You can see we went down initially, but we actually came back up and finished in the top half of the candle body. That's not really full out selling. And then to open the new year on Tuesday, we gapped down, we traded down intraday, and we came back up and we finished right where we opened. So now in 2 days, we've seen, I don't know, in those 2 days, we probably saw 50 points chopped off of the S&P 500. And yet intraday selling was almost negligible. Now, yesterday was a little bit more selling. We did gap down and then actually sell off a little bit further and close near the low. So I will say that there was a bit more selling yesterday than we saw the first couple of days. But that's sometimes what happens. Market makers actually start to push the big rock over the mountain to kind of get it started. And then we start seeing traders start losing some of their profits, or maybe even losing on recent trades. And so they begin selling. And it's one of those things that kind of builds upon itself. But a lot of times it gets started by the market maker. So one of the things, or market makers. So one of the things I'm going to be watching for is some kind of reversing candle. Maybe we gap down. I think the futures this morning were kind of mixed. I'm showing the Dow up 75, the S&P down 4, NASDAQ down 77. That was as of 10 minutes ago. So that could have changed. But one thing we can look for is if we do gap down on some of the key indices, maybe we reverse today. Maybe we come back up, print maybe a piercing candle if you're a candlestick fan, or maybe a bullish engulfing candle. Or maybe we have a lot of selling in the morning today, come back up, finish with a hammer. That type of thing is what I would be looking for from a bullish perspective. Obviously, from a bearish perspective, what you really want to see is big, solid, red-filled candles, which means not only do we gap down, but we sell off intraday all day long. That's distribution. Haven't really seen any of that. We had 1 day here, maybe 1 day here, and maybe 1 day there. Since the end of October, I count maybe 3 days in 2.5 months, or well, probably 10 weeks. 3 days in 10 weeks that I would say on this chart are bearish candles. If we go back and we go back a few years here, but here was the top at the beginning of 2022. Now these candles, you can't really see them. Let me go back only 2 years. Maybe let's go 2 years and 3 months. So here was the selling. You can kind of see, I don't see a whole lot of gap downs. I see mostly selling, and I see the volume picking up. Here, volume definitely picked up over the holidays, but it's much lighter than what we saw late November and throughout much of December. So I've got my questions. Right now, as the market pulls back, like I said, we're seeing some of that money rotate out of areas that are overbought and into some other areas that have been oversold. So I'm not really upset with the action at this point. And my longer term signals remain mostly bullish, some very much so. So I'm not too concerned about the pullback, but from a short term trading standpoint, things can always get a little bit worse. So be a little cautious out here right now, but I'm looking more for something that suggests a big reversal than I am something that looks like we're going to morph into, a bigger downtrend. The NASDAQ 100, this one did go down below the 20-day, but again, you can see pretty significant gaps taking us down. I would say most of the selling, and I haven't looked at this to confirm it, but I would say most of the selling in the last 3 days has been triggered by gaps. In other words, more selling has taken place at the opening bell than has actually taken place during the trading day. And I personally find that to be manipulation more than distribution. IWM, this one has seen more selling. And yesterday was a big day for the bears because not only did we sell all day long, we closed back below the 20-day moving average. Personally, as we got close to that 20-day moving average, I kind of moved a little bit out of my IWM and into the TNA. And I stopped myself right out again during the day yesterday. And I think futures on the IWM were actually up. So I have to kind of figure out what to do there. But I sold half at 194. I think it was 194.30, somewhere in there when the IWM was down, with the thought, and it was intraday, with the thought that if it came back up and closed above 195, I would get back into it. I just didn't want to take all the risk that I had in play on that intraday breakdown. That's one of the things we talked about yesterday in our trading room. Our live trading room was different strategies that you could have going in to this kind of a trade where you're trying to maybe leverage off of a key support level. But this one didn't work at the time, at least at the moment. We'll see maybe if we gap back up and take off. As I've said now for probably the last 4 days, first thing you have to do to end a downtrend is you have to print a higher high. So until we print a higher high, which would be today, we would have to get through 197.67 to effectively confirm that a downtrend might, not definitely, might be ending. Just because we set a new high doesn't mean it's going to end, but you have to have a higher intraday high to stop a downtrend. That makes perfect common sense, I hope. Keep putting in lower lows and lower highs, the downtrend's in play. You cannot end a downtrend without putting in a higher high intraday. So that's one thing I'm looking for on the daily chart. To the downside, if we do gap up and fail, which is possible, gap support, obviously 192.50 is going to be a big level on the IWM. If we can't get that gap support, I mean, I really don't see a whole lot until we get back down in that 185 area, which is really interesting because if you pull up a weekly chart, the PPO is just going. I believe this is starting a very significant move to the upside on the IWM. And if I'm correct, the rising 20-week moving average should hold. Where's the 20-week moving average? 184.71, basically 185. So if we go back to that daily chart, this congestion right in here from where we took off was 185. So it kind of lines up both on a on a daily basis and a weekly basis. Now, I'm not saying we're going down to 185. Who knows where we're going to go? Market's really hard to call in the short term. But I would be very prepared if we get down to 185. I don't believe the IWM's closing below 185. That's my opinion. I'm not sure it goes down below 192.50. Let's watch the action. But I always like to step back from the daily chart because you can be swayed a lot by what's going on in the daily chart. I like to step back, take a look at the big picture. And I think in the big picture, things look much, much more bullish. So just keep all of that in mind and manage your trades however you wish based on some of that information. The transports gapped down yesterday right to the 50-day and then traded below. So this is definitely more of a bearish candle. And maybe you could argue, I don't know if we have a higher close up here or not, maybe a slightly lower PPO. I usually wouldn't pay much attention to a divergence that looks that close. I mean, I want to see a serious divergence form. That one, I'm not sure if that's a divergence or not. A negative divergence, I mean. But if it is a negative divergence, when I see a negative divergence, I look for the 50-day or 50 period test. And in this case, that would be all the way back down around 15,000. That would also be the breakout of this bottoming reverse head and shoulder pattern. So here was the left shoulder. There's the neckline. Here's the head. Back to the neckline at 15.2. Come into the right shoulder. And then we break out above 15.2. We get back down to 15.2. That's price support. Probably getting pretty close to that rising 50-day moving average. So that would be a level on the transports maybe to watch for a reversal. All right, let's go into the chart of the day. I got a lot to cover here in the next 5 minutes. But again, 30-day trial gets you into tonight's event, which is the January effect. Make sure 30-day free trial. We can't give you anything more. It's free. Check us out. You will have to give a credit card, but we'll send out an email before your trial period expires. We don't want you to get charged if you're, if the service isn't for you. That's fine. But anyway, check that out. You can come to tonight's event. And if you just want to go to the event for Saturday and you have no interest in signing up long-term, simply by being a 30-day trial member cuts off 50% of attending Market Vision 2024. So you can click on Market Vision 2024, get more information and register. That's coming up on Saturday. Looking forward to it. Grayson Rose, Director of Operations at Stock Charts, will be joining me. I think we're going to have a great 5-hour period. That's about how long I suspect it's going to take. I do 3 different sessions, including my long-term 2024 forecast at the end of my final session. And Grayson's going to be talking about all the enhancements that they've made at Stock Charts and how he uses that in some of his trading. So you don't want to miss this event. Chart of the day. I put this in one of my articles last week, but I wanted to show you Citigroup. I think Citigroup's gotten off to a good start. And I actually expect that the banks are going to do well. I mean, I showed you how the financials are starting now to move up as we come out of this, what appears to be, we come out of this inflationary scare or period, whatever you want to call it. But that trend line, I mean, if you go back all the way to June of 2021 and you connect this trend line, you have multiple tests. And in November, when we started seeing all this strength, the banks started rebounding and Citigroup made a very, very big breakout of that downtrend line. So I'm looking for big things out of Citigroup this year. All right. I told you XLE. I wanted to show you the seasonality on XLE. Well, here it is. And I just went back 7 years. Normally I don't use 7 years, but I was just looking at it. And it's 6 out of the last 7 years. Energy has been up in January, and it goes up by an average of 4.6%, almost 5%. So that would be probably close to $10 on the XLE. Or no, actually XLE is 86. So that would be 5% would be $4. So we're talking about maybe getting up to 90 or maybe into the low 90s on the XLE if it follows the history over the last 7 days. Now, just to be fair, I'm going to stretch this out because when you get past 7 years, you can see things start deteriorating. So, let's keep everything objective. But I can say recent history, that has been the case. XLE has been doing well in January, and it's making a somewhat of a decent breakout on its chart. So that may be an alternative. It's more of a value play. A lot of these energy stocks pay dividends, so that could be part of what's going on. All right, it is 9:28. Market opens in 2 minutes. I said I was going to go through 30 Dow stocks, so I'm going to go through them, but I'm going to do it pretty fast. Here are the last, oh shoot, that's only 3 years. I want to go back 5 years. Actually, I'll go back 10 years. And you can apply your style to all the charts in a chart list, which is what I just did. All right, so what I'm seeing right now on Apple, first of all, I see a cup off of an extended uptrend. I see a handle coming back right now. I think Apple's going higher. I like the center line test on the PPO and the subsequent rise here where we come up. And now that we're pulling back, we're right around that 20-day, maybe or 20-week, maybe we're just below it. Yeah, less than $1 below it. Of course, the week's not over. But I think this is a good area for Apple. Personally, I don't own it, but I'm probably going to have some today, especially if it's down a little bit intraday. So I like Apple. All right, other stocks. Amgen. Amgen just broke out of a long-term cup handle. Love Amgen for 2024. American Express breaking its downtrend line and now trending up above the moving averages with a solid PPO. I like AXP. Boeing Boeing is going to eventually need to get through this 280 level. It did have a very strong finish in 2023. Now pulling back, I think the current level down to about 225 is where I would expect to see a reversal in Boeing. Caterpillar just broke out recently. Caterpillar hasn't really been participating like many of the other stocks during 2023 and into 2024, but it has been participating recently. And I like that PPO coming up off of that center line or close to that center line. I believe the 20-week moving average holds as support on Caterpillar and it goes higher. Salesforce.com made a nice breakout above this prior top, which was back in the summer right before we had that correction. Look at that huge candle that came up, went through. So I now look at price support from 230 to 240, and there's your 20-day as well. I like Salesforce. Cisco Systems, I don't know what's going on with this stock. I mean, here we are at $50. Guess what? In 2019, we were at $50. Cisco has been an underperformer for a long time. I think there are so many better options. We're now trading right on the moving averages. PPO is actually negative. I'm passing on Cisco. I don't like Cisco. Chevron continues to downtrend. If we get a little pop in energy, maybe we get Chevron up to 160. Outside of that, I mean, I'm just not, I think it's sideways consolidating. So I'm not a huge fan of Chevron at this point. Disney, this is going to be an interesting test right here because we had been downtrending. You can see a massive bottom that came in right at $80. I mean, if you look at $80 to $82 going back the last 9 years, that's been massive support. And we went right down there again in the fourth quarter of 2023 and nice bounce. Now we're pulling back. Do we hold that 20-week moving average? I think for long-term investors, I really like Disney here. If you close back down, you have a weekly close below 90 and you get nervous, you get out if you want, but you still have major support sitting down at 80. Disney's got some very valuable properties. I don't know. I think that price, even though if I look at just about anything else on the chart, maybe I'd still be a little concerned. I mean, you could take these tops and we're still not getting through the trend line. But I think Disney is one that has tremendous value. Technically, it could make a big bounce off this 20-week moving average. It's kind of one of my bottom fishing plays of 2024. And if you know me very well, you know I'm not really a bottom fisher. So don't really enjoy the sport. I would rather follow the big fish that are already moving. But anyway, I thought I'd point that one out. I do like this one, but as a trader, I would probably watch that 20-week moving average. So give it a few dollars, but that'd probably be about it for me. Dow, not really seeing a whole lot here. I mean, just a lot of sideways consolidation. Seems like every rally fails. If I were to take a chance, it would probably need to be on the 20-week moving average, and it would need to bounce right off of that or I would be out. Goldman Sachs, I actually love what's going on here with Goldman Sachs. I think this trend line's been broken to the kind of like Citigroup. A little bit, this one's not as steep of a downtrend, but it has been downtrending since the end of 2021. I believe we're going to break out above 400. That's what you're looking for here. And I think Goldman Sachs is going to have a good year. Home Depot, I like the recent breakout above all these tops coming across here. There's actually gap resistance as well, all in this 330, 340 area. We went through, almost got to 360. Now we're pulling back. I like this pullback. I like to buy a buy on this pullback. Obviously, the 20-week moving average would be best entry, but the fact that we've already fallen probably $15 from our high, I think sets up pretty well in Home Depot. Honeywell, it's strengthening, still in this sideways consolidation. Most of these stocks, if they've strengthened, but they haven't really broken out, I would be watching the rising 20-week moving average. I sound like a broken record, but that's the signal that I like to look for. If this is truly now beginning to uptrend, a 20-week moving average test should hold. IBM finally getting a long-term breakout. I've been head faked by IBM so many times over the years, I'm going to pass on it. But technically, I can't argue. Nice breakout. Intel, I love Intel. I've been talking about Intel for quite a while. Look at how this one broke the downtrend, had a triple bottom, broke, and then look at how this 20-week moving average continues to hold. That is why I follow the 20-week moving average. Bad week so far for Intel, but look at the move to the upside it had. Perspective. It's all about perspective. When you have a big move to the upside, you are increasing the risk of a big move to the downside. So Intel's getting hit, but I like it going forward. I think Intel goes higher. Johnson & Johnson, another one sideways consolidation. This is almost kind of rolling over, but we are getting the breakout here. I mean, I think it's got a shot to 175. I'm not as convinced the long term is as good for Johnson & Johnson as many of these others, but better than what it's been. JP Morgan made the breakout in the fourth quarter, has taken off. I love JP Morgan in 2024. I pretty much just love JP Morgan anytime, especially for longer term investors with a nice dividend yield. That's I consider one of the safer plays in the Dow. Obviously, when banks take a hit, they can go down, but overall, that's a pretty good stock. Coca-Cola got a nice double bottom in here. So if we get a breakout in 2024 above about 63 or 64, that would be the key for me. You could take a shot early here, just bouncing off the 20-day. You can see it going through, coming back down, testing it, and now breaking to a new high. That is a bullish break above the 20, test of the 20, and a new high. So I like Coke. I think this one is going to eventually make the breakout. I think the aggressive entry is here. I think the more conservative entry is actually higher, making sure you get through the break, that key resistance area. McDonald's up here against this key resistance, but fourth quarter, look at the volume coming in during this move to the upside. I love McDonald's. I think it goes higher. 3M, like Citigroup, this is one that broke that downtrend channel and now looks to be trading much, much better. I think any kind of a pullback, we do have resistance at 110. Any kind of a pullback down near or at that 20-week moving average, I think would be an interesting play on 3M. Merck, look at Merck actually trying to make this breakout. That's what we want to see. The weekly PPO from below the center line has crossed. We have gone from bearish momentum back to bullish momentum. A breakout would be nice here on Merck. Microsoft continues to be very strong. I have a big issue on this one, though, and that is because on the recent highs, look at that divergence. That's a really nasty divergence. I don't think Microsoft is going to get crushed, but I don't know that 2024 is going to be a great year for Microsoft. I really think some of these value stocks, the small caps, international, I think some of the other areas may play catch up to some of these bigger stocks. I don't think the big ones like Microsoft are necessarily going to have a fall, but I could see maybe more sideways consolidation, more false breakouts, pulling back, another false breakout, that kind of a year for Microsoft. So I got to see more out of Microsoft. We are at all-time highs or near all-time highs, which is never a bad thing, but momentum seems to be waning. It had a huge move in 2023. Don't be surprised if it lags in 2024. Nike, I can't say anything positive here. I mean, footwear got started. It looked like Nike was doing something. It's come down. It's lost its 20-day or 20-week moving average. Unless we see a big reversal by Friday, tomorrow, this is not a good look on the weekly chart. I'm passing. Procter & Gamble, sideways action. I think the pattern overall is pretty good. Uptrend, sideways consolidation. We got to get this breakout through about 150, or excuse me, 157, 158. Travelers making the breakout above 190. Can't really argue here. It's in that financial space. I like the financials. I think Travelers will do well in 2024. UNH, equal highs here, but a little bit of a cup off of an uptrend. Let's get that breakout. I mean, we've been dealing now for almost 2 years without getting new highs on UNH. This could be a nice breakout. Again, healthcare providers, a little bit more defensive, a little bit more value oriented. I could see this one making a breakout and having a decent 2024. Visa, I love Visa. Just broke out recently. It's in a great area of the market, I believe, to continue to perform well. Verizon broke this downtrend and right now is in a nice uptrend, but it's also getting to a key resistance level. I'd have a hard time buying it at this level. If it pulls back and gets close to that 20-week moving average, that would be the time to buy. And I believe Verizon pays pretty nice dividend too. So getting it at a key support level with a nice dividend might be a good play for some who again, don't want to take huge chances with their capital, because I think we probably, after the sell-off, I think Verizon's probably was at, or I can't imagine we go back down below 30 on Verizon. I mean, we look 10 years. I mean, 30 is a pretty low price. So I think we're probably going to continue to rise, but I got to see that breakout above 40 before I would be interested. WBA, they just came out and lowered their dividend. I think I saw that this morning. I saw a news article very quickly, but Walgreens, I believe, I think they raised their guidance, but then lowered their I'm not sure what happened. So go back and check the news, but it wasn't overall good because of the dividend reduction. I think they cut it in half. And as a result, stock getting absolutely crushed today. And just look at the chart. Is there any reason to get excited about Walgreens? Seriously. I mean, the PPO now, weekly PPO, has been below zero for 2 years. It got down to -10 at a period when the market was exploding. I mean, it's one of the worst performers in the market. Finally, it got a little bit of love short term. Now here we go right back again to the downside. Stay away. Walmart. Walmart trending up, came back down to the 50-week moving average, starting to turn back up again. I don't know that Walmart's going to be a massive leader, but I do like it. I think it goes higher in 2024. And that's it. It took me 12 minutes. I was going to try and do it in 10. But anyway, it's 9:40. It's very late. So let's take one look at the market, see what's happening. Dow up 66. We got the S&P 500 down 1. NASDAQ down 48. We got small caps up 1 point. So we did come back from earlier struggles. Mid cap, though, down 2 points, but both pretty close to the flat line. We got the VIX now moving up, closed above 14 yesterday. I think a trip to 15 would not be an issue at all. I think we could even go to 17 if the selling were to accelerate a little bit, but that's about the high that I'd be looking for on the VIX before the next rally. That is it for me. So again, thank you so much. Come join us tonight, please. It's free. You have to sign up, but if you don't like our service or you just want to come for the event, unsubscribe or cancel. And I want you to hear about the January effect. So make sure you come in, sign up for a 30-day trial. And then if you want to come in for Saturday, you can at least get that half off by being a trial member. Anyway, check all that out. Love to see you. It's going to be a packed house, and I'm looking forward to it. Got some interesting thoughts for 2024. Anyway, have a great day. Enjoy the rest of your week, and I will see you tonight, maybe hopefully again on Saturday. Happy trading, everyone.